Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Today I'd like to talk to you about the annual allowance tax trap. Now, what is that? Well, there were a number of reforms back in April 2006 when the government introduced something known as pension simplification. Now, once they announced that, my suspicions were raised because, being the cynic that I am, I thought, well, no government wants to make anything simple. If any of you out there have ever tried to fill in any government forms or try to understand any government jargon on any subject, but particularly taxation, you've probably been bamboozled, as have the rest of us. So I thought, well, it can't be pension simplification. I thought it must be pensions complication, and it must be a way of raising additional taxes. So it's just disguised taxation. Unfortunately, my cynicism was proved correct, because that's exactly what it has become. Now, amongst the reforms was a limit on the amount you can pay into pensions known as the annual allowance. And simply speaking, the allowance is £40,000 a year as long as your earnings aren't too high. By saying too high, there are calculations to work out what is a high income, and above that level of income you will find that your annual allowance gets reduced from £40,000 a year down to as little as £10,000 a year. So if you're fortunate enough to have a high income, that's good, all well and good, but you find the amount you can pay into your pension is reduced. In addition to that, there is another further reduction in your annual allowance known as the money purchase annual allowance. So if you start drawing an income out of a money purchase pension scheme, then your tapered annual allowance of £10,000 gets reduced even further down to £4,000, which is a very low amount to have to pay. So you really need to be aware of these tax traps. There were other reforms, but this blog is too short to go into detail about those. And one notable extra reform was lifetime allowance, which relates to the total value of your pensions as opposed to the annual contribution limit. We now have both, which I think is a bit galling, because it's bad enough having an annual contribution limit, but to have a cap on how much you can have in your pot as well seems like a double blow to me. What I thought I'd do is illustrate this particular annual allowance tax trap with an example of an existing client. Let's call him Joe for simplicity. Now, Joe is not what we'd call a high earner for the purpose of calculating the annual allowance, which means you've got to be earning £200,000 a year. He's earning about £80,000 a year. And the reason it's £80,000 is because he's done what's called salary sacrifice. He has sacrificed some of his own income, which means he is paid by his employer into his pension instead of him taking it as a salary. And the reason why you would do that is because the employer and you save national insurance, and that saving is usually ploughed back into your pension by your employer, so you get an extra benefit there. Now, the client is earning about £80,000 a year, Joe. He has sacrificed £25,000 a year. His employer also pays £25,000 a year into his pension, and he makes a personal contribution of £20,000 a year. Now, if you're still with me with all these figures flying around, that makes £70,000 in total. But Joe is only personally paying in £20,000. So you can forgive him for thinking that the allowance is £40,000 a year. He's only paying him £20,000 a year. So, hey presto, I'm not exceeding the annual allowance. Now, of course, most mere mortals would think the same. But when you actually dig deeper and look into HMRC's rules on this, it's not quite as simple as it seems. First of all, the salary sacrificed amount of £25,000, which is given up to be paid into his pension scheme instead by his employer, that is still treated as part of his annual allowance. So now, instead of paying £20,000 a year, and he's paying £45,000 a year, which means he's exceeded the limit already based on his own contributions and the amount that he has sacrificed, £45,000 in total. And of course his employer's paying him £25,000 a year. So you might ask yourself, there's a combined contribution of £70,000 a year going in, some funded by his employer, some funded by him. Who pays the tax bill on the excess above £40,000? Well, believe it or not, it always falls on the individual taxpayer, not on the company. Which means that in effect, because the total contributions are £70,000, although the member of staff is only paying in a personal contribution of £20,000, that means he has exceeded the annual allowance by £30,000. Now, hang on a minute, we've got a problem here. Why doesn't he ask for a refund from the pension scheme because he's overpaid? But guess what? The government doesn't allow that. Remember my cynicism I mentioned at the start? It's just a guise to make you pay more taxes. This £40,000 limit isn't a limit on how much you can pay into a pension scheme. It's a limit on which you get tax relief for paying into a pension scheme. So the refund isn't allowed. Joe has to pay tax on £30,000 except if he has any unused allowance out of his £40,000 limit from the previous 3 tax years. Unfortunately, in this case, he did have £15,000 worth of unused allowance, which he carried forward. He offset it against his £30,000 overpayment, and that left him with a £15,000 amount on which he is taxed at his tax rate, which happens to be 40%. So £15,000 at 40% is £6,000 tax bill, totally unexpected. Ouch. This is obviously not the type of tax bill you want to be hit with in an unexpected manner. Now let me tell you, this is one of many, many tax traps. It's literally a booby trap. You know, you can be caught out unwittingly by numerous ways in which the government will tax you on pensions if you're fortunate enough to be a high earner and or have a large pension pot. The key here is that if you are in that category, if you are a high earner or you've got a large pension, then be aware that you could easily make these mistakes. So it's always best to get advice from a financial planner, especially one who practices cash flow planning, which we do, because our software is so sophisticated, you can plan your annual allowance and your lifetime allowance to mitigate the effects of unexpected tax bills. So you know where we are, you know what to do, and you know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.